So once again, welcome to our second session for Target Alpha Alberta. Just a quick intro to Target Alpha Alberta for those of you who weren't here last week. Target Alpha Alberta is a student-led organization that works towards promoting financial literacy among youth. And we do this by hosting conferences, competitions, as well as providing resources to students by presentations. Just to keep in mind that at the end of this presentation, we will be sending out the presentation to everyone who attended, and this session will be recorded and put up on YouTube for you guys. In today's lesson, we will be going into more depth about investments and different ways to invest in the stock market. And so just to keep in mind that this is more of an informational session. Could we go back to the disclaimer slide? Yeah, this is just an informational session, but questions are always allowed. Just put them in the chat and we will answer them the best that we can. And a disclaimer that this is just investment advice, and the information we're presenting is solely for educational purposes. So make sure that you do your own research before you actually invest. For those of you who weren't able to attend our last session, we will be giving a short recap on lesson 1, and this is just an agenda of what we will be presenting today, starting with the recap of lesson 1, and then we will go into more detail of index funds, what they are, ETFs, and mutual funds. And this is just a schedule of how and when we will be hosting our events. So last week we had our intro to investing, and today is our index funds, mutual funds, and ETFs. Next week and the weeks after, we will be having those, and the sign up form is on our Instagram in the bio. Yeah, and now we'll just be giving a recap of lesson 1.
So in the previous weeks, Shannon and I presented, we talked about stocks and the stock market and a general introduction to investing, as well as why we should care and how useful the stock market can be for your financial needs. If you need more information about what we presented last week, you could always check out the presentation slides that we have or will send out, as well as the recording that will be posted up on YouTube. And then lastly, we want to make an exciting announcement that our sponsor, NDAX, will be giving free t-shirts to everybody participating in these lessons.
All right, so I'll be explaining what ETFs are. So exchange-traded funds are a group of stocks that are put together into one security. A security is a replaceable and tradable instrument that is used to raise capital. And generally, ETFs are safer to invest in than other stocks, as it is a collection of stocks, and it makes it difficult for the price to fluctuate rapidly. So generally, when you buy a single stock or a singular stock, the price can change really quickly. But when it's a collection, it makes it difficult for the whole price of the entire ETF to fluctuate. So ETFs are a type of mutual fund, and they're traded as regular stocks. And as a matter of fact, there are ETFs for almost everything you can imagine, and this ranges from crude oil and food. So experienced investors will highly encourage beginners who are looking to invest to search for an opportunity involving ETFs due to the risk of losing your initial investment being low. So ETFs allow for the investor to be exposed to companies that have a singular stock that is expensive and presents a high risk. So if you're new to the stock market and you want to invest in one of the bigger companies, like for example, like Amazon or Tesla, and you want to make sure that your investment is safe, you can always invest in an ETF where it's a collection of stocks and you're already exposed to the company, but it's also at a lower price. So a prime example of an ETF is the ARKK. The ARKK is a disruptive innovation as an introduction of technologically enabled new product or service that potentially changes the way the world works. So companies within the ARKK include those that rely on or benefit from the development of products or services. technological improvements and advancements in scientific research relating to the areas of DNA technologies, industrial innovation in energy, automation, and manufacturing, and the increased use of shared technology, infrastructure, and services, and technologies that make financial services more efficient. So the ARKK is an actively managed ETF that seeks long-term growth of capital by investing under normal circumstances, primarily in domestic and foreign equity, securities of companies that are relevant to the fund's investment theme of disruptive innovation. So as you can see, the ARKK is just a collection of stocks as mentioned previously. So on the next slide, there's a group of different types of ETFs. So there's commodity ETFs, currency ETFs, sector industry ETFs, stock ETFs, inverse ETFs, bond ETFs, and leveraged ETFs. And all of them are, they have a general theme that make up the ETF. So for example, currency ETFs trade foreign currencies. This could be a group of foreign currencies, whereas a singular stock will give you exposure to just one currency. Bond ETFs are made up of corporate or government bonds, and inverse ETFs aim to develop returns on the decline of the indexes they track. So they're all based around a specific theme to decrease the risk of the investor. So some pros and cons of ETFs include cheap exposure to industries. As mentioned before, the ARKK presents exposure to beginner investors and gives them a cheap alternative route to investing in these companies. Exposure to a collection of larger companies with a lower cost, more risk management as your portfolio will have diversification built in. So again, ETFs are a group or a collection of stocks which already diversifies your portfolio. Some cons of ETFs are that overinvesting can limit exposure in one industry, and low liquidation rates because not many people look forward to buying these funds. And yeah, that's basically what ETFs are. And to summarize, ETFs are a collection of stocks that do not fluctuate much, and they're based around a general theme and have a low risk involved.
Okay, next up, we're going to talk a little bit about mutual funds. So basically what a mutual fund, it's when many investors combine their funds into one larger pool of money, and then this pool of money is funneled through professionals who then invest the pooled money in a number of investments. Like I said, these funds can go to a wide variety of investments, whichever the professional money manager decides is best. And the key thing that makes this different or unique is that it's done through companies versus by individual investors. Now, of course, mutual funds have their pros and cons. And just a quick disclaimer before I get into them, we are in no way encouraging or discouraging you from investing in mutual funds. These are just some more objective pros and cons taken by reliable sources and are not our own opinions. With that said, moving into some of the pros of mutual funds, one of the key ones is that it has a lower risk for new investors because professional money managers are the ones managing the money. Because they're more experienced, there's a higher likelihood of the investment profiting as opposed to a less experienced individual investor trying to invest money. And of course, this means that there's also no knowledge required on the side of the investor. There can also be much more diverse investments. Like I said earlier, money from mutual funds is invested in a wide variety of investments. And this also makes it lower risk because if one investment turns out to be a bust, others are still intact and can still turn a profit. Professional assistance is also one of the pros. This means that the money is managed better. And like I said earlier, there's a lower risk for losing money, and there's a higher likelihood for higher returns. They're also a lot more convenient and easy. There's not too much involvement from the investor. And this is really good for people who are investing part-time with a job elsewhere, who may not be able to like spend a lot of time looking at these investments. However, of course, there are cons to mutual funds. One of them is the lack of control, because depending on the personal preference of the investor, they may want more control over exactly where their money goes. And this doesn't really happen with mutual funds because it is being managed by a professional. Another thing is that it's tax inefficient. This can be due to possibly changing profits, returns, and costs, etc. And then the taxing on the eventual profit distribution can be quite unclear and unpredictable. There's also added fees and expenses just because there is a professional managing the investment, and this is also known as a sales charge. Next slide. There's 7 different types of mutual funds. There's a lot of options to choose from just because mutual funds are a bit of a vague categorization that can include a lot of different types of investments. First example is the money market fund. These are short-term fixed income securities. These are typically safer with lower returns. Next, there are fixed income funds, which give fixed returns and usually earns money through interest on the investment. There are some of these are more riskier than others. For example, high yield corporate bonds, which give more return, but in turn, this also means that there's also higher risk. There's also equity funds. This is the investment in stocks, and this can include a wide variety of stocks. Balanced funds, investment in both equities and stocks, and this attempts to balance risk with income, hence the name. Index funds invest in an index rather than individual stocks. This is usually at a lower cost just because index funds are lower maintenance. Specialty funds, investment in specialized mandates. Examples of these are real estate or commodities. And lastly, we have fund of funds, which invests into other funds. I did see a question in the chat about whether or not mutual funds are long-term investments. Like I kind of just went over with those types of mutual funds, it kind of depends on what kind of mutual fund you're investing in. And just because mutual funds are quite a wide categorization, there's not exactly an exact answer for that. Next slide. So how do you invest in a mutual fund? So one key step is researching the mutual fund, and this means determining how risky your investment will be. And note that typically like a low risk investment will have lower returns, and a higher risk investment will likely have higher returns. So depending on, I guess, how much money you're willing to invest and how risky you want to be investing, it might change what kind of mutual fund you want to be looking at. And then, of course, after determining the desired risk behind an investment, then you can look into options for where to invest. And once you figured that out, you can speak to an advisor or a company and then finally purchase the fund. So just to give a couple examples of mutual funds, there's the broad market index, Vanguard total stock market index fund, international index, Vanguard FTSE All World X US Index Fund, and I won't go through all of them just because you guys can see them on the screen already.
Okay, so I will be going over index funds. Next slide. Okay, so index funds are basically a type of ETF or a mutual fund. So they fall under one of the categories that Sunny and Parth went under. And so index funds are basically a bunch of stocks that are put together and they're under an index fund. So when you buy one index fund, such as the S&P 500, you're essentially just buying like a wide variety of stocks that are combined into one. And this is an easy way to diversify your investment portfolio. And yeah. And so what this means is, so when you invest in an index fund, your investment gets split up into multiple stocks. So in a way, it is safer, but don't take that as actual advice because it can also be very risky. So if one of the stock, sorry, I wasn't done. So if the value of one stock in your entire index fund goes down, you won't be losing all of the money that you invested in your index fund. Okay, next slide. And so they're designed to mimic a benchmark, and this benchmark can be an industry such as the S&P 500, and it is a passive investment. So you maximize returns by minimizing the buying and selling. So it is like a long-term investment. And so these are types of index funds. They are on the screen, so I'm not going to repeat all of them, but just as an example, term-based bonds are basically bonds that you can buy, but they can be long-term or short-term. So how you choose on which index fund or some one you want to invest in is dependent on your investment goals and what you would like in return. And so the pros and cons of these are, the pros, we'll start with the pros, is they are low risk and they have a steady growth since they are based off of an index. And there are fewer fees than actively managed funds, and they diversify your portfolio. Since you are in your portfolio, you will have multiple stocks. The cons can be there's a lack of flexibility because you are investing in a fund. So in that fund, you don't really have a choice of which stocks you can have in there. It just is all categorized under one. So you have less control over individual holdings. And so how can we apply this to youth today? Feel free to leave your answers in the chat. So yeah. Okay, so we have something in the chat. You can invest in index funds now, and when you grow older, you'd have money that grew with you over time, which is also true. And from Harvey, we have youth today can look through different options of funds to determine which would work better for their long-term investments. We'll go to the next slide. And so just as a recap, for index funds, they can be long or short-term investments, and they are a part of ETFs and mutual funds that are under a specific category, and they are a bunch of stocks in one category that you can purchase.
Sunny and Parth, would you like to recap your sections too?
Yeah, I'll go first then. Basically, just a quick overview of what a mutual fund is. A mutual fund is where individual investors pool money in a larger pool of money, which is then managed by a professional money manager, and this larger pool of money can go towards a large variety of investments.
So for ETFs are a collection of singular stocks or just stocks that are put together, and it creates a environment where the investor experiences a low risk situation where like they won't gain too much money or lose too much money if anything was to happen, because the collection of stocks makes it so it's difficult for that to happen. Whereas a singular stock, that singular stock could fluctuate like high or low, creating a high risk, high reward kind of situation. And yeah.
Okay, so if anyone has any questions, you can leave them in the chat, or feel free to email us at contact@targetalpha.ca for more information. Next slide.
And then here's just a reminder of all of our social media, such as Instagram, Facebook, LinkedIn, and our website. While we're here, I'm going to take the time to just remind everyone that these slides will be shared with you, and the recording of this meeting or of this webinar will also be shared. And also, we will soon be sharing a Google form to get everyone's address to send you an NDAX t-shirt.
Thank you for your involvement.
Yeah, thanks everyone for coming today. We'll keep this meeting up for 5 more minutes for anybody that has questions, and then we'll be ending it.